Today we're talking about markets and emotions and how we just don't care.
Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
Hi, my name is Aaron. I'm a financial advisor in the Bay Area. I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today. And thanks everybody for listening and watching.
Great to be here as well. So there's been lots of scary news and stocks are down, and I'll have a few conversations with clients. And one of the things I've been aware of for myself is how just not phased I am. And we're going to talk about this today. And I've seen research with other financial advisors that they tend to be pretty even keel, just as a profession. It's like a self-selection idea that those that tend to be very middle of the road emotionally are attracted to this business because they can handle the ups and downs pretty well. And they will serve their clients well by being that just steadying influence. And so when I think about myself, I have to I don't think it's a superpower of mine, but it's just a regular power if I had to give it a label. But I will be out I'll be playing pickleball or with other friends, and they'll say hey, did you see what the stock market did today? I was like, no. Aren't you a financial advisor? Yes. And you check the stock market? No, I have no idea what's happening. And I'll get some news later on, but it's not something I do on a regular basis. And I wanted to talk about this idea of just how you and I deal with emotions related to markets, both for ourselves and helping our clients. And I was describing this to another advisor. I do want to provide caveats of I don't think I'm a sociopath when it comes to this, where you removed all feelings, because when it comes to sports, I can get really, really excited, really high highs, really low lows when it comes to sports. When I'm playing with my kids or watching them do stuff, all the feelings. And especially when I'm watching my kids play sports or I'm coaching them, then I'm really, really excited. And so I do have all those big swings, but when it comes to the stock market, I just never care. I'm not phased at all. And so my first question for you is are you similar? Do you have you noticed that of where do you have emotional reactions to financial news or the stock market, or either up or down? Do you have that kind of introspection of, do you react at all?
Right. Yeah. I could say I'm comfortable with keeping my emotions in check, right, through all of this. And I've had to wear many hats in my career. So, I remember in the option space where we were trading markets all around the world. Literally, there's something always going on. There isn't ever a case where there isn't a fire on planet Earth. So at some point, there's just too much.
So, do you think you become desensitized to it?
No, I think I just, like you said, maybe there's some self-selection bias here where just part of your personality, if you're going to be doing this, you can't be incredibly emotionally swayed by, all the things that can potentially happen, which are of great magnitude for sure. But, you have to titrate that and compartmentalize it in terms of how it might actually impact what you're doing, right? And be able to make rational decisions under these very stressful circumstances. So yeah, certainly in the in the options market, it was like that. And then, I also had the luxury of being in the hedge fund space during Trump's first term. So, that was a situation where we got to see a lot of this turbulence in real time, where it was specifically my job to be on top of what's going on a pretty much a per minute basis in terms of what's going on in the news. I mentioned in like a conversation or two ago that I was trading volatility, which is the fear gauge of the markets, and it was very closely tied to Tubbs Streets during his first.
Okay.
That's something we were acutely aware of, especially when he had his spats with Kim Jong-il, and they were going off with their back and forth of the missiles and all of that. And I recall many late night conversations at like 2-3 a.m. on oh no, another tweet.
Oh no, another tweet.
Here we go again. So there have been times where I've been very acutely aware of what's going on, because essentially it was my career. But certainly when it comes to the markets from a passive standpoint, it's a whole different story, because it's a different ballgame. You don't really need to be aware of what's going on, because the premise with a passive strategy, which is what I have been doing with pretty much most of my life savings, and what I do with my clients and myself, within my practice, is it's passive in nature. So what that means is we've already reduced the risks so that each client and each individual and myself, we're comfortable with riding out the market turbulence, whatever happens to transpire. And then the notion is, okay, we prepared for this. We knew it was going to happen. It happened. There's nothing really to do except, potentially take advantage of opportunistic tax loss harvesting or whatever it happens to be. But these are all strategic objectives. They're not tactical because of something that recently happened.
Yeah. So I want to you had mentioned you keep your emotions in check and compartmentalize. Like, do you feel that? I want to be careful about using that word because we talk about feelings. So, do you think that you have these feelings and you're able to set them aside to make rational decisions, or are you not actually phased? Do you not have any feelings, good or bad? Do you feel like, oh, the market went up a lot? Do you feel good about that? The market goes down. Do you feel bad? And then you set that aside to be able to make good rational decisions? Or does it not kind of show up on your radar, or does it not just enter your brain at all?
It was interesting. A little story popped in my head as you were saying that.
We love stories, please.
I don't know if I should name the actual person, but one of these very high up investment managers, billionaire. One of my coworkers was going up in an elevator. He was on a higher floor than us, so he was in the elevator with him. And I guess my coworker asked him, "Don't you ever get phased, when all this crazy stuff happens?" And the billionaire investor just kind of shrugged and said, "It's not my money."
Oh.
Obviously, that was more. That's kind of a joke, but I think more importantly, I think the approach that I always brought to it is, what does the data say? What do we know? What do we don't know?
Okay.
And what does that mean in terms of what we should do from here?
Okay.
So I think I've been good at that. I've been good at the notion of, okay, here's what we decided. Here's our strategy. Here's our contingencies. Here's what the data is currently telling us. And, frankly, sometimes the right answer is we don't know, right?
Yeah.
There's not enough. A lot of the times it's just, look, there's not enough information here. Now, we need to have a plan for that. Often in the quantitative space, when we're building models and it comes across something exogenous, the instinct is always, oh, we got to override it because look, this situation has never been seen before. So we got to jump in and do something different. And what I always like to say is, well, every day something exogenous can happen, right? Just new things are going to happen from now until infinity. You can't plan for it in every model. Otherwise, it'd be like a future seeing machine, right?
Yeah,
And
yeah.
there's just way too much noise. When you make a prediction model, you're just looking for the slightest of slightest edges that can basically show itself over large amounts of trials or data, or days, etc. So often my intuitive sense has always been to, okay, you stick with it, right? You stick with what you
Okay.
plan to do. You don't always jump ship when something new happens. And I have been able to compartmentalize that. I think it's just been something where it's been part of my nature to say, even though this is a very trying time, even though the sky is falling, you got to stick with what you know.
So, okay, so it almost feels like we have two different paths of arriving at the same place. Because it feels like when you talk about like there's always a fire,
Yeah.
and like you can't choose which one to overreact to or even kind of react. And so like it almost feels like you've become desensitized to, you've seen so much news that it's now just kind of all noise, and you let the passive strategy, let the markets work out themselves over a long enough time frame. Like, would that be a fair assessment of what you think of?
Uh, I got to think back, because I don't know if I was always like that or if I transitioned to that. I think it's kind of always been my temperament to follow the data, even from the
Okay.
beginning. So
Okay.
I don't know if a desensitization was required. It just kind of the approach I brought to it.
Okay.
Just going through it, it was a lot easier when the stakes were smaller, right? Like when I first started, basically after you go through a few of these rodeos,
Yeah.
it does desensitize you a bit. Like I saw the crash in the .com, right? We mentioned all that. I've lived through the great financial crisis when I had a good amount of assets invested.
Yeah.
So even what we're seeing today, we haven't seen anything yet. Like,
Yeah. Yeah.
this is a walk in the park. In fact, we should expect more volatility than we've seen in the last few decades, right? Like, it's been
That is,
so,
so that reminds me of a couple things. One, when like friends ask like, "Oh, the market's down, like, are you worried?" I might go check the S&P 500 1 year trailing.
yeah,
Like I
right.
never year to date, but always the 1 year trailing. And it's like, market's down. What do you mean? We're still up 6% from the 1 year trailing. Like, I'm just making up numbers here because
Yeah, yeah,
that was what I think it was 2022. No, I think it was 2022 maybe last time. But
yeah, right, yeah,
there's a year like, I mean, yes, peak to current, like it's kind of down a lot, but it's
yeah,
like the chart actually looks like way up and then down like halfway. Like I'm not expecting the markets to average 20% per year.
yeah,
And so what looks like a 10+% drop from the top is still a 10% up over the last year.
yeah,
And so
right.
like that is one thing I have. And I think that the other thing is like for me, I think I've done a pretty good job of stocks aren't for short term whatever anyways.
Mm-hmm.
It's I'm actually very happy for clients to keep kind of larger cash balances. I have seen enough positive emotional responses and stability that if they have extra large cash positions, then they're actually happier. They seem to be do fine. And for me, like as one of the caveats, like when that billionaire was riding the elevator, I'm invested the same way my clients are. So my money is also coming down,
Mm-hmm.
but I know that the stock side is like decade plus,
Mm-hmm.
and the stocks are for longer than any presidential term.
Yeah,
So for me, it's not there's always news, there's always data, and it becomes noise. For me, it's how much do I actually ask clients pretty often, like, what are your cash balances? Like we actually that's one of the things I do check in regularly, in part because it's the data doesn't always link to my financial planning softwares or links break. So I do want to get updates on that. Make sure we have enough cash aside for taxes, especially with RSUs and stock options. But it's just kind of, do we have enough? Are we over the cash reserve that we decided that helps you feel comfortable? Do we want to increase your cash reserve to help you feel a little safer? Like I'll pay attention to cash balances, but the stocks, I'm not touching it. I don't care. I haven't looked at my stock market, my accounts, so I have no idea what the impact is, if any, because this is not money for this year or next year or 5 years from now.
Yeah. I think so. Even when it was my job to follow the markets on a per minute basis, for a decade, I didn't really look at my personal portfolio. Like it just didn't matter, even over all that. So, I had to follow it. I had to know what's going on, but it didn't phase me as far as what's going on with my personal investments. No, the strategy of the retirement assets, my personal investments, and basically the money I'm managing now for clients is long term, and so the strategy doesn't require being tactical on a short term basis. It's just not a function of that. Just zooming out a bit, the high level notion, frankly, is there's two phases, right? There's the accumulation phase where you're gathering assets, right? And then there's the decumulation phase where you're pulling assets out and wanting the portfolio down. And in theory, if the mean return for the market gravitates towards, let's say like 7% over market cycles, you actually want lower returns when you're accumulating assets, right?
Okay.
If you could hope for things, you'd want things to go down when you're investing and you're putting money in the market, right? If you know things are going to average out over the long run. So when markets fall and you're actually in that first phase of your life, maybe be happy. You're going to be investing more, right, over the next X amount of years. Now, things do become concerning. Yeah, if you're in that decumulation phase, especially if you just started that decumulation phase, right? That's the sequence of return risks that we've touched on many times. But the notion there is we've anticipated that. we have some sort of glide path of saying, we're not pedal to the metal straight up to the day you retire and then we go to cash, right? No. We slowly ratchet down, your risk so that when you do approach that, and the worst does happen, like you retire this year and the market's down, whatever it happens to be. Well, no, it's okay because we have this buffer, right? We've softened the leverage on your portfolio. It's not 100% stock anymore. Well, it's not 80-20 anymore. It's more closer to like 60% stock, 40% bond, whatever you're comfortable with.
So, I guess, does that in a weird distinction, like you see so much data that it becomes noise. I guess I think back like when we talked about the compounding idea, like maybe this gets back to that self-selection of advisors kind of idea where the conversations my wife and I have always feel like we're looking 5-10 years out. And that's like we have our day-to-day, like how do we make sure we get kids to all their school and sports stuff on time, okay? And we have like when kids are out of the house, which is 10 years from now. Those are like the conversations we kind of have. And so I wonder if it's just again that self-selection, like do advisors tend to think long-term anyways? And I'm not looking at 2026 at all. It's neither what I need to work on right now, nor is it long-term, like I don't want to say glide path, but like path that we'd like to work towards. Does that resonate for you?
Sure. I mean, the whole long term aspect. I mean, that my business is called investing forever. Like, it's kind of baked into the name, to the brand.
So, like, I guess, do you think about 2026 at all?
Well, okay, so from an investment standpoint, what is there to think about, right? Like, I don't know,
Yeah.
but no, right? But from a financial planning standpoint, sure, right? Because there's certain things on a per client basis that are important. Like, for example, 2025 Tax Cut and Job Act is set to roll off, right? So that might create planning opportunities, that might shed light on next year. But then, you have the trump card where things could be in any direction depending on whatever gets passed this year, whether it
Yeah.
gets extended or not. But yeah,
That,
those are
that's
all
a good point. Like, I do have a couple clients where knowing we're selling something, like one selling a property in 2025, we're not going to sell this other thing in the same year. We're going to wait until 2026 so that we're kind of spreading out taxes over multiple years. So I guess
right.
that's a good point. There is still some planning ideas around that.
Right. Yeah. So again, that's planning. It's not investing, right? That's
Yeah.
all. Even though it might be related to, harvesting gains or whatever happens to be, that's
Yeah.
more because of the plan and not because we're taking some sort of tactical advantage of what's going on in the markets.
Yeah. Okay. So I guess one of the things I keep coming back to, because I do want to talk about the idea of not feeling phased, but this now in reverse. So I've written something on my website several years ago, and it came up because I was looking for my own writings about the Serenity Prayer, and I'll get to that in a second. But the title of the article was, I sat in cash while the market was up 42%, and I was happy about it. And then the first day that I put cash in the market, it dropped 5%, and I was still fine.
Okay.
And the story was, I had cash ready to buy a house. So this was about 2013 to 2016. So I've been in this house for 9 years now.
Yeah.
And the market was up 42% in that time frame.
Yeah.
But like,
right.
I knew I can't invest this because this is the cash I need as the down payment for the house. And so we had saved into it. So we have some extra cash, and then I can actually look up the day that I made, like, okay, we have extra cash, we've bought the house, time to invest it. By the time like the cash gets transferred into the investment account, purchases are made, is the day before the Brexit vote.
Yeah.
And so I can look up the date if I wanted to, but it's like the first day drops 5%. First day. And it's one of those things of, yes, I could have dollar cost average, like there's other emotional reactions, like, but one, I wasn't like, no, I don't need this money anymore. It's no longer short-term down payment house money. It's now long-term financial independence money. It actually turned into like helping me start the business idea.
Right.
But again, that's like long-term money. And I use that as an example where even if I knew the market was going to drop 5% that first day, and I decided to do like a dollar cost average over a month period, I don't know if you remember this time frame, a month later is still higher. It dropped 5% in one day and then still was higher a month later.
Right. Yeah.
And it speaks to that idea of like what you're talking about, like, we just don't know. And so any other strategy I could have done, like, other than like wait exactly one day. Like, that's the only theoretical strategy that could have made money. But even then, like, I'm not going to make that kind of prediction.
Right. Yeah.
Any other reasonable strategy I could have employed would have actually cost me more money. Where dollar cost average, do half now, half later, like whatever you want to do. And so a lot of times, just no, you get in the market and we'll see what happens. Like, I don't care. It's no longer short-term money. It's now long-term money, and wasn't phased by it.
Yeah. I should hit on a few things. For example, when you said you're comfortable with clients maintaining a large amount of cash, I just want to clarify or confirm that It's not because they're looking to time the market if it happens to drop and then jump in. It's just because they like the cash for
Yeah,
security purposes. It makes them
correct.
feel more comfortable.
It's usually okay. We need this much cash set aside for taxes because we
Yeah.
had some stock sale
Yeah.
or RSU vesting. We have these projects that you'd like to do this year or next year,
hmm
buy a car, work on the house, something like that. And then it's like just regular cash reserve.
Yeah.
So one of
Emergency
my
fund.
clients, she was in her late or early 30s at the time. I think she may have been like 33, 35, and she was just a little scared and wasn't sure about holding or wasn't sure about investing too much long term. Her parents have had some bad experiences, so she had $100,000 as a cash reserve in her early 30s, and her total annual expenses were like 40K. So
Right.
she had a good income and she was able to
Yeah.
save a lot, but she was holding 2.5 years worth of expenses as a cash reserve.
Yeah.
And I have seen that enough clients like that arbitrary round number. Like if no one ever wants a $9,000 cash reserve, it's 10,000 or 20 or 50 or 100, something
Right.
like that. But I have other clients that if they have a net worth of 2 million, depending on their income is household income is 400 to 500,000, yeah, we'll have a $200,000 to $400,000 cash reserve. Like we acknowledge the opportunity cost idea. Like, okay, this means that you probably have to save a little bit more for retirement, or you have to work an extra year or two on the back end, depending on how investments do. But we'll keep a couple $100,000 in cash, and it just helps them feel better.
Yeah.
And I say, like, cash reserve, we're never going to touch, hopefully. Like, it's just going to let it sit there, earning interest. And back, 6 years ago-ish, 7 years ago, nothing was paying any interest, so I didn't even care about the interest rate. Now it's like, okay, let's make sure we've moved to something in the 3.5% to 5% range, depending on current interest rates. We're no longer in that 0.1% savings account that the banks don't seem to want to increase.
Yeah. Right.
So it's a little like, okay, let's make sure we're getting something. But yeah, six-ish years ago,
Yeah.
no one was paying anything, so I didn't care what the interest rate was.
Yeah.
But I think that's the idea. Like, if you are thinking short term, 2025, 2026, that's cash. I don't like, we're not using any kind of stock market strategy for that 1 or 2 year time frame.
Yeah. Yeah. So, okay. So a bunch of things. So I think we probably said all of this, but just to clarify, so the typical standard advice on cash is like 3 to 6 month emergency fund, right, of expenses, something like that, right? Where if you have a 2-income household and you have a fairly stable jobs and a stable living situation, then maybe something closer to 3 months might be okay. And then if it's a single income household and then, just some rockiness maybe on the horizon, medical expenses, whatever, maybe 6 months might be okay. And then obviously,
I guess
yep.
I tell my clients that this is an interesting like sidebar of like how we figure out a cash reserve.
Yeah.
Which actually I think is really relevant for today's conversation. I first phrase it as, okay, we're gonna pick some round number. Go pick whatever sounds good in your heart, sounds good in your belly, kind of thing.
Right.
I actually say 6 to 12 months of expenses, but it's like it's not 6 to 12 months of income, it's 6 to 12 months of expenses.
Yeah, for sure.
Like, let's use that as a rough guide. Your expenses are 10K per month, 120K per year.
Yeah.
So 6 months would be 60K, 12 months would be 120. You don't have to go to 120, but like, if I give you those numbers, what numbers sounds good to you? Like, okay, we'll do 80K as our cash reserve. That sounds fine.
Yeah.
Then we're actually going to wait like 3 months and check in, but 3 and 6 months later, how does that feel?
Yeah, right.
Because you'll notice it could either like it actually feels good, it feels a good amount, or you know what, it still feels just a tiny tight. can we bump that up a little bit? I'd feel just a little better if we bump that up just a little bit.
Yeah.
Or you'll have to be like, I see that money sitting there doing nothing. I see my 401k going up. I see my other investments going like, it's just sitting there doing nothing. I think I can handle less cash. I'd rather have a little more of that invested. Let's go down to like 50K.
Mm-hmm.
And it's okay to reassess what your ideal cash reserve is over time.
Yeah.
And this is not market timing. It's not saying like, oh, I had 80K in cash and then something happened and now I'm going to invest 30K.
Right. Yeah.
This is reassessing what our cash balance is. And it also allows you to, okay, as you, especially like dual income household earns more money, RSUs start vesting. We've identified, okay, here's how much we're setting aside for taxes. Here's how much for like projects and expenses in this 1 or 2 years. Here's how much is a cash reserve. We can invest the rest.
Yeah.
And that helps us kind of determine of the excess cash how much to invest. We don't have to like play that game each time of like, okay, this time I think we should invest 30K and next quarter I think we should invest 60K. Like, no, we'll reassess our cash. You're still maxing out 401ks, so we're doing good there. And you had RSUs vest and we sold those, so time to invest this much.
Yeah.
So I think that's an experiment that probably does actually lead to my clients having more cash than other advisors.
Mm-hmm.
I can see that. On the flip side, I also have more clients that do hold on to concentrated stock positions. So they want to kind of see if their single company stock can help them become rich and or financially independent sooner.
Right.
So it's almost like a barbell of risks, I guess I'd say, like larger cash on the safe side and more single company stock on the aggressive side.
Yeah.
But do you have a way that you think about figuring out a cash reserve?
Well, it's pretty much what I said, and that's for just the emergency fund. And then you add in all the others like taxes or, big items or saving for a house or whatever it happens to be. So those are all separate goals that are earmarked. But, just 2 other points on that. One, the other point is, I'd mentioned this, but just throw it out there again. One thing I use for my clients and for myself with cash is I use a service. There's many of these services. So it's Max My Interest, where it just opportunistically jumps around the cash to different banks that are offering competitive rates. So you probably net like another 0.5% to 1%, but also you don't have to think about, are you getting a good enough rate, compared to what the market is giving you on cash. It'll help keep that in line with what the market is offering.
So I've actually been very, very comfortable using money markets. So I use SCI as a custodian. They offer a good money market. I have clients who have Vanguard accounts. Even just the Vanguard money market is usually pretty competitive. I don't. Sometimes for just the ease, that they might be able to get a little bit more, but I'd be curious to hear your thoughts of, do you care about money markets versus CDs?
Well, CDs have more of a lock-in, so I'd say I prefer money markets above CDs. But then, for whatever reason, sometimes banks just give you a better cash rate. Like, not all banks, but some banks may opportunistically just have like a promotional rate that's a bit higher. We can show you, for example, right now.
I'm going to pull up the Vanguard money market, and I want you to pull up their Max My Interest. And I'm really curious.
Yeah, let's see. Okay, so I don't know if we need to share, but we got 4.05% right now.
Okay, so I'm looking at the Vanguard Cash Reserves Federal Money Market Fund. Add more shares at 4.24%.
Okay. Yeah. So.
Yeah. All the money markets are 4.24, 4.23.
Yeah. So a few things. These can be higher. They can be just because of right. And money market could be whatever. I don't think it's going to be life changing either way.
it does. There is fluctuation in the interest rate
Yeah,
more with the money market.
it'll
Where
fluctuate on the daily.
yeah, so that's like they have to get that current date. And I would say a couple months ago it might have been below 4, so this is back up above 4.
So I guess what I'm saying is they're both heading towards the same new normal, and sometimes one will under or
Yeah.
overshoot, but they're all, it should wash out.
I
guess
agree.
is
I
the
agree.
point. Yeah.
So it's kind of like whatever's easier for you. Like don't spend too much time trying to like.
Yeah.
As long as you're getting 4-ish and not 0.1, we're
Yeah.
good.
And just to confirm, is the money market subject to SIPCA or FDIC?
SIPCA.
Yeah.
S-
So
SIPC,
the other slight benefit is these are subject to FDIC, which has a stronger insurance backing.
Okay, so I want to double check. Do you know of any stories of anyone losing money in a money market? Like I know in 2008 when it
that
broke
was
the
the
buck,
story. Yeah.
and withdrawals were frozen, so you couldn't get money out for about a week or so.
Yeah.
But I don't know of anyone who actually lost money in a money market.
Yeah, it's more of a feeling thing, right? Like,
Yeah.
So this is that subjective ground where some people just like the confidence of saying this is FDIC insured,
Yeah.
and okay, so let's just mention it, right? So FDIC insurance is on typically for bank accounts. It's about 250,000 individual. Was it 500?
It's per registration.
For
So
a joint per registration that you have with the bank.
So theoretically, you could do your own individual, your spouse's individual, a joint account, and you could also do like a trust account. And it's like each one is different.
Probably like a CD account as well. And if it has a separate
I think it's per registration per bank. So then you can go to the bank across the street and do the same thing. So you could get $1 million of FDIC insurance across a household.
Yeah, but then also this service maximum interest, it'll automatically siphon 250 to all these banks. So it'll aggregate it. So it's just one way to, if you're dealing with a lot of cash, whatever, down payment a house, or you had a windfall or whatever, it just helps with those types of things. So okay, that's FDIC for SIPCA. It's a little different because this is insurance program for brokerage accounts. And it's not used to guarantee against losses like FDIC, because brokerage accounts are supposed to go up and down, right? They will lose money, right? That's by design at times. But it's designed to prevent, it's more about fraud, right? And about misdeeds that are happening rather than insuring against losses. So the protections may not be as great. So that's why some people prefer the FDIC. For example, when I custody assets for my clients at Schwab, we have the choice of, is the money held in a custodial account that's FDIC protected or SIPCA protected? I always choose FDIC just because A, we don't hold so much cash anyway with brokerage accounts, but B, just, why not just have that one less thing to worry about.
Okay. Yeah. I think I have seen the money markets have that combination of both easy and a good interest rate.
Yeah. Slightly more risk is why you may expect slightly more very marginal return.
And again, it's almost like, do you think it's a realistic risk?
Yeah, this is one of those things where,
like, we're just like super splitting hairs way out on the safe side of the spectrum.
We're like 3 sigma away from anything rational.
Stock and cash, and we're like, we're like right down here.
Yeah, I don't even know if we should entertain more.
Okay, that's good. Good point. Cash, money market, doesn't matter. Whatever you want, whatever's easy. Like,
but I did have a third point. So the third point was, the tricky part when cash starts to build up is inevitably it brings the timing mindset into people's eyes, right? And this can come up just innocuously on, we got to make the 401k contribution, or sorry, the Roth IRA contribution, but is now a good time? Maybe I'll wait a bit, right? Or, I forgot to deposit this 50K bonus
Yeah.
right into the brokerage account, but is now a good time, right? All of these questions keep surfacing when things like this happen. And just to lay out the case, which I think we've laid out many times, but just one more time for this episode. This has been studied from various aspects, but the three options in general you have are: option one, you have cash, put it to work, right? Immediately.
Yep.
Option two, dollar cost average. Option three, let's try to time the market and roll the dice and hope for the best. And, as you can imagine, option three does not work out so well.
Yeah.
It's very hard to do. There are many examples and research papers and empirical evidence to suggest that that's not a good idea, even though it can seem very tempting. But between option one and two, option one actually does beat out. Just empirically, if you have the money, you should put it to work. You shouldn't try to even dollar cost. But if it makes you feel better, it's not the worst case to dollar cost into it. And this is, again, assuming you have the money. Now, assuming you don't have the money, meaning it's coming in every month, then dollar cost, right? Just don't build it up. Once you get your monthly paycheck, you have a structured savings amount, just move it in every month, right?
Yeah. I agree. It's like the dollar cost averaging maybe has some psychological benefits, but you are more likely to miss out than you are to gain.
Yeah. And here's why, right? On average, does the market go up or down?
Up, yeah.
Right. So there's some opportunity there. Here's the other thing I like to put out there. Even if you do put it to work, technically you're still dollar cost averaging. Here's why. You're not just investing now and never again, right? You're going to be investing literally forever, right?
Yeah.
So for the rest of your life, at least. So each individual instance is another opportunity to kind of dollar cost, right? To average out your risk. So just because it seems like a lot, that 7,000 you're putting to work all at once, you're going to be doing that year after year after year after year. So eventually you may hit some good ones and you may hit some bad ones, but on average, it should wash out.
Yeah. I personally, again, I wrote about this. I put it all in one time, lost 5% a single day. But one, it is so much easier. Yeah. It's just set, put it in the money and then forget it. And that's I do something under the psychological benefits of, just in case it drops the first day, you protected yourself. At least I didn't put all of it in there. But then it's watch the market as it goes up and down over that time frame until you put the next one in. I don't know if you actually feel better the second time you put money in.
It's a slippery slope. You're opening up a lot of opportunity to let your emotions be played with.
Yes,
because you once you let your emotions get triggered a little bit, they love it, right? They love that. It's like candy for your emotions. It gets that dopamine spike. It's like what was that? So the reason why gambling is so effective to keep people hooked, right, is because for many individuals, they feel better when they almost win but don't than when they actually win.
I've never even seen that. That is interesting.
Yeah, so that's why it's so compelling, because you get that rush from almost winning but not actually winning. That's where you get the biggest spike in emotional response.
So I have seen some reports that online betting, especially FanDuel and DraftKings, most of their profits come from parlays.
Mm-hmm.
Do you know what a parlay is?
I can guess. You jump off of another bet to...
No. A parlay is you pick 3 to 12. It could actually be even more, but 3 to 12 different events. You can combine a game result, a score result, like an over/under. You buy an individual player result, and you are kind of multiplying the odds of each one of these. And so you could end up with a parlay of, say, 10 games. So especially on an NFL weekend where all the games are happening at the same time, you quickly, each one is a 2 to the 10th kind of thing.
Okay. Yeah.
And so you can see In fact, I'm going to do this. Let's say you just bet a spread for 10 games. And you can theoretically turn your $100 into $10,000 if you can get all 10 games. Okay. But most people, like you said, that feeling like they'll get 8 out of 10 or 9 out of 10, and they were so close.
Right.
Like, oh man,
Yeah.
I got 9 out of 10. If I just bet them individually,
Yeah.
you would have made money.
Yeah. Right.
But because it doesn't have that multiplication factor
Yeah.
that the parlays require, which is it's so unlikely to happen, which is why the payoff is so big. They make so much money on these parlays. Like this, it has been their most profitable thing because it feeds both that big payoff idea. Like, I don't want to bet $100 to win $100. That's boring.
Right.
I want to bet $100 to win 10,000. And it's so unlikely that that's how the online bettors make their money.
Yeah. I mean, obviously it's rife with all these different biases that get capitalized on.
So it's actually gotten pretty sophisticated where if you get like the first 8 results in a row, the book knows that you could go hedge against those other 2 games.
Right.
And so they will offer to buy out your ticket for less.
Yeah.
It's like you've put in 100 and you've got the first 8 out of 10 games.
Yeah.
We'll buy your ticket for 2,000.
Right.
Not 10, but it's like 2,000. So like, and that's kind of like the way the math works out. Like you could actually
it's a new expected value.
Exactly.
Yeah.
And so like, do you cash in at like, oh, I put in 100, I've already up to 2,000. Do I try and quintuple, like trying to get the last 10, like the last 10K? I only need 2 results now.
Yeah.
So yes, they have gotten really, really good at offering things that make themselves money, that get people to participate, that make themselves money.
Yeah. It reminds me in the option selling world. We would offer to buy back. And the benefit to us is, you cross the spread twice now. Instead of letting it expire, right? And you cross the spread once, so you double the commission.
Oh, that's interesting.
Yeah, it's 2 trades, right? Technically.
Yeah. Okay, so the last thing I wanted to mention, because I mentioned it before, and I think this is really relevant. I've written about, and we've discussed before, the Serenity Prayer. It was a prayer, but it's the same idea and the philosophy still works. But it's, may I have the serenity to accept the things I cannot change, the courage to affect the things I can, and the wisdom to know the difference. And when it comes to feelings, especially related to stock markets and economy, like one of the biggest things is just what is in your control and what is out of your control. And the stock markets are out of your control. There's nothing you can do. And so you have to like let it go. Just let, and I think that's what I tend to think about for me personally, like how I have been able to not care is I've been doing this for 20 years now, almost, of it's out of, I've built up that idea, like it's out of my control, so I don't care. And things like how much you save are in your control, so you should really care about that.
Yeah.
And this tends to play out quite a bit. And if you can, I try to get clients to think about like that. What is in your control? Let's focus on that. So it's not only just ignoring what's going on in the stock market and out in the world that's out of your control.
Yeah.
But it's almost like doubling your focus on the things that are in your control, and you get positive compounding from your efforts.
Yeah.
And the wisdom to the difference is, I like that it's phrased as wisdom,
Mhm.
but in this case, it's pretty clear. Like, what is in your control, what's out of control. How much you save is very easily in your control. Stock markets are out of your control.
Well, it's clear for us.
Okay, that's a good point. That's a good point. Again, maybe it's because I've been spending 20 years.
Yeah.
Like maybe it takes time to build up that resilience idea that you mentioned earlier.
Well, for example, a couple of decades ago, 80% of investments were actively managed, right? In mutual funds, 80% of mutual fund investments were active, and now it's like it crossed like the 50-50 threshold. Maybe like 5-7 years ago, something like that. But now the majority is passive. So, just as recently as 2 decades ago, investment space thought that you could beat the market.
Yeah.
And it was a worthwhile endeavor. And, I think a large percentage of the population still holds on to that belief, right? So I don't think it's a rare mindset.
I don't
Like,
know
for
if
example,
I agree with that, but I have no way of countering that.
well, for example, anybody investing in crypto is doing it for the speculation of it,
That's
right?
true. That's true.
Yeah, like I think the good barometer is the percentage of assets that are invested in passive funds, right? It gives you some indication of how prevalent is the notion that you can beat the market on a consistent basis. And if somebody's investing in an actively managed fund, okay, they could be just oblivious to the fact that it is actively managed. But let's say you just kind of know you had a choice and you picked it, the active. Well, then there's some understanding that you did it because you thought it was possible.
Yeah.
You thought it was a worthwhile endeavor. And, I think I would say, frankly, even the clients that come in that buy into the passive notion, I still see active bets. I still see active plays. Even, for example, even if you're mostly in index funds, the selection of those index funds might very well be active, like the best performing index funds, right?
Yeah.
That's a very active decision.
I have you get people who choose to only invest in the US.
Yeah,
they don't want to invest international.
Uh-huh.
They will overweight small cap or emerging markets.
Sure.
Something like that.
Yeah.
I can see that.
So I have a few points that I say that kind of differentiates what I try to put out there. And one of the key points is I try to be as purely passive as possible. And it's not easy to do because it can sneak in through all these different ways.
Yeah.
Even if you're doing a pure index strategy, you may be overweight a certain area, or you may be doubling up, a certain area.
Oh, yeah.
And you may have gaps in a completely other area. Well, these are active decisions. If you're foregoing a certain market, but you're excessively weighted in another market, like you said, like more domestic than international and so on. So I think a lot of people may be doing that because they feel there's some benefit to it, right? Why else would you be doing it? So
it's that feeling like I see the news. I know something bad here is going to happen.
Yeah.
And I think that the best joke counter I have to that is like when you see the news, like this person predicted the last recession, and this is what they're predicting now.
Yeah.
And it's like, okay, if you are able to track their like headline record, it's like they have correctly predicted 9 of the last 2 recessions.
Right.
And it's one of those things like, yes, there's some people who are like, oh, this is it. It's going down forever. And they're wrong.
Yeah.
Oh, this one's going down and they're wrong. This one's going down and they're right.
Yeah.
And like, okay, does it actually make them right? And you start to go back to that, just the wide up idea of like, yeah, there's enough people out there that are using random luck.
Yeah.
That one person actually did predict 2 of the last 2 recessions.
Right.
But even that doesn't make it that we know they actually have any predictive abilities.
Yeah. Yeah. So, I think this notion is quite prevalent. Like the whole existence of CNBC, right, is to pervade the notion that all this information is useful for making important financial decisions, right?
Yeah.
And the countervalence is that it's not, but that doesn't get its own channel, right?
Yeah. That's the fox and the hedgehog idea. The hedgehog, like, it's going down or it's going up, makes for great TV. And the fox is like, I mean, it could go down. It might go down a little bit. It could go down more. It's probably like, okay, based on this economic, my guess is we're probably a 40% chance of going down more than a certain amount, but like a 6% chance it's still going up. Like, makes for horrible television.
Right. Or just someone who says it doesn't matter.
Yeah.
Doesn't matter.
It's like you and I are not ending up on TV as guests of CNBC anytime soon.
Not anytime soon, no. If there's a doesn't matter CNBC, then sure.
It's like I don't know, but let's check what happens in 2 years from now.
Yeah, call me back later. Right. So I think just one more point came across, because with the tariffs, for example, when this was one of those things where Trump said he was going to do it. Everybody knew he was going to do it.
Okay.
Everybody said the market was going to crash when he did do it. And he did do it, and the market crashed. Right?
Okay.
So then, then the question is, well, why didn't we do anything?
Okay. My logical, like, assessing your thing is the jump from Trump said he was going to do it, so we knew he was going to do it. That's like no, just because he said something doesn't mean we actually know that he's going to do it. That's I think the broken link in your logical chain.
Right.
Okay. That being said, it's also like, I have no idea what this is going to do for the next decade. I don't care about this year. I don't care about the stock market in 2025 or 2026.
Yeah.
Like, I have no idea what the effect is going to be over the next decade.
Yeah. You know what I might tag on to that, just being, here's that whole slippery slope thing. Let's say you bought into that line of thinking that I just put forward, and you did pull out. But then what are you going to do?
Yeah, I wrote that for a client email yesterday. Like, okay, even if we knew it's going to go down, when do we get back in? Because that's also been just as impossible to predict as the first part.
Yeah, I would argue even more impossible.
Yeah. We're going from impossible to even more impossible.
Yeah. How there's like different orders of infinity.
Yes. Yeah.
So potentially even harder. Let's say here's the issue. Oh, you knew this was going to happen. You reacted. You got out. Okay, now what? Right?
Yeah.
And here's the concern. Now in your mind, you set this precedent that, oh, this is easy. When I feel like something is going to happen, I react to it.
Yeah.
But now you got to play it through, right? Okay, now when do you get back in? For example, the people who got out in like 2007, before the great financial crisis, that maybe they read the tea leaves correctly. There was no all clear bell that rang that said now is a good time to come back in. and we've hit the bottom.
Yeah.
For the next 3 years after we hit the bottom, pretty much every news article said, no, don't get back in.
Yeah.
Now's not a good time. Now's not a good time. And in that 3-year period, the market went up over 100%.
Yeah.
And if you had missed that,
It's
no professional
the most
advisor could get you back.
the most likely thing would be you get out, it actually goes up.
Yeah.
Okay.
Yeah, you don't perfectly time.
Yeah. Then it goes down a lot.
Yeah.
Okay. And you're still you're anchored up here.
Yeah.
And it goes up like over time.
Yeah.
And then, okay, we're now actually above where we were.
Yeah.
I think I'm ready to get back in, but you already, again, you lost it up. You get back in and it drops.
Yeah.
So you lost on the upside and it's going to drop again.
Yeah.
And like, do you like, oh, I was wrong. This isn't the time I get back out.
Yeah.
Or can you have the potential like lock in your loss, your opportunity loss, and stay for the rest of the ride up?
Yeah. Have you seen that Carl Richards graph about this specific case?
I've seen a lot of them, but
maybe I could show it.
Okay. So
okay, here it is. I got it on Google. All right. I'll describe it for the listeners, but essentially it's pretty much what Aaron was describing. Let's see here. I'm gonna share the screen. Quickly click on an image so I show something.
There you go.
Okay, good. To the source. So the graph basically is what Carl Richards has. He has his own advisory business, I believe, but he has all these pretty nice graphics that try to titrate human emotions into a single Far Side kind of comic graph or whatever, something very simple. But his website is a behavior gap. Will include a link to this article. But the notion is essentially when markets go up, people have this FOMO, feel like they're missing out, and they jump in. And then inevitably the markets start going down and they get super fearful and they sell. And then the market starts going up and then they get fearful that they're missing out again, so they jump back in. And essentially what the chart says is just repeat until you go broke. That's the cycle of wealth destruction.
So I have another Carl Richards ones. I think it's really relevant for today.
Okay, you want to share yours?
Yeah, so I'll share my screen now. Right here. Man, we're doing great over here. Let's do share screen. Okay, so can you see that?
Yeah. Yeah, sure.
Yeah. So this is this is what I talked about. Like
the Venn
diagram. Same idea of the serenity prayer, but like it's the things you can control. In this case, it's things that matter, and that's what you should focus on.
Right. The intersection of the two.
Yeah, it's that idea of the things that are out of your control. You don't focus on. Don't give any mental energy towards.
Right.
But yeah, that's. I love Carl Richards. I love his drawings. He has something for everything that you and I talk about.
Sure. That's right.
So, okay. Anything else you want to wrap up with today?
Well, I think we covered all the bases. The main thing is maintain that long-term focus, right? If you're investing in the stock market. Oh, there was one thing. So what helped me is kind of looking at the data that helped inform my confidence in the markets. So Aaron, you had mentioned, if you zoom out just 1 year, you kind of see that the dip today is not meaningful.
Oh, yeah.
When I think about investment timelines, I often tell my clients, the money you put in today, we're going to be taking out in decades, right?
Yeah.
And in decades from now, even when you're in your 50s, the money you put in your 50s, we might not be taking out until like your 70s, 80s, right? Something like that.
Yeah.
So we're talking about decades. And if you zoom out to decades, literally the blips, even the 2008s, right? They all start turning into little bumps in the road. And the other way you kind of can infer this is something where I actually crunched the data going back like 150 years. I just stitched together what was available with the U.S. markets, even before the S&P was like the S&P 100, before the 500, and so on. And I started looking at rolling period returns. And yes, the worst 5-year rolling period return was like the Great Depression, where you're down cumulatively like 70%, something like that. However, if you had held on for another 10 years, the worst 15-year period, you're basically flat, right, in the markets. And then every single 25-year period, you're up a couple percent, right? So minimum after inflation, after inflation. This is worst case. So, if our standard time horizon is a couple decades, well, I'm pretty confident, right? If history is to be our guide, that this is going to come back, and that's what informs the decisions today. Obviously, the entire world can end. We got bigger problems than our balance sheet. If that were to be the case.
Yeah, I like how we talk about emotions and markets, and so much of our conversation was just how much cash do you have.
Yeah,
your cash isn't going down. Let's keep a healthy cash reserve and look at that instead of looking at your investment account.
Just the two other things to dig onto that is, and again, we kind of mentioned this, but we've already done the hard work before the crash, because we've sat down and we said, when the crash happens, what amount of risk are you comfortable with, right? And so we're not 100% stock. We also diversified, so we're not fully in the U.S., right? My portfolios are like 40% international, so they're not taking the full brunt of all of this, right? So that they're diversified. So this was all done before we put the money to work, right? So that when, not if, when the markets are crashing, we've already done the hard work to realize we can ride this out.
Yeah. Okay. I want to say I feel better. I actually feel about the same. Actually, it's a good conversation. I feel exactly the same.
Sure. Good stuff, Aaron.
Okay. I'll talk to you later, Trishul.
Okay. Thanks, everybody, for listening. Thanks, Aaron. If you enjoy these conversations, do spread the word. Thanks. Bye.
Bye. We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical as no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.